Hi, and welcome to the Fearless Money Management Podcast, where we empower women to take control of their finances. I'm Claire Strong, and today I'm chatting with Heather Steer, who's the founder of Divorce Transition Mentors and is also a co-founder of Split FYI, which is a resource group for people who are going through divorce. Hi, Heather. How are you?
I'm great. How are you?
I'm great. For those of our listeners who are watching on YouTube, I love your red top. And for those of our listeners who are not watching on YouTube, she's wearing a red top and I really like it. It's cute. It looks so comfy and warm. I love it.
Thank you. Thank you. I'm very excited to be back. I love these conversations with you.
I love them too. And just remind, maybe some of our listeners didn't catch our last episode, which if you haven't already checked it out, you should. It was excellent. Heather was talking to us about, finance and divorce, basically. But just explain to our listeners a little bit about what you do, Heather.
Absolutely. So I am a recovering CPA and a certified divorce financial analyst and a certified divorce coach. So I spend my time working with my clients on being a strategic thinking partner and educational resource, particularly around finances, but with an understanding of all the emotional work that also has to go or does happen as you're going through divorce. So I have a private practice that is based in California, and I work with people around the country, particularly with my Split FYI community and the resources that we provide to, again, support people emotionally and physically and financially with resources around the country.
Can I just say, I love how you say you're a recovering CPA. As soon as you start saying that, I think you're going to say, I'm a recovering alcoholic or a recovering drug addict. No, she's a recovering CPA. I love that. Yeah. Oh my God, it's so funny. But listen, Heather, just explain to us a little bit at a high level what we were discussing last episode, because, we're going to kind of continue the conversation in this one, but go a little bit deeper. So, what were really the key points of our last episode as it relates to divorce and finance?
So I think the key things are, particularly when you are the financial outspouse, which I define as being the person that may not have been the ones paying the bills, having the eyes on the financial dashboard. It's a very natural thing to give up control of certain things in life because you're in a partnership. And so therefore you take on different roles in a relationship. And I think a lot of people feel particularly a lot of shame around not being financially connected to their lives as they're going through a divorce. So in our last episode, we talked a lot about that and sort of some key things that you should be looking at, getting back on board as soon as possible if you are facing a divorce. And those are things like, what credit do you have available to you? Do you have a credit score? Do you have a credit history? Is it good? Is it bad? What needs to happen there? Other things, we touched a little bit upon budgeting. We touched a little bit upon just understanding, there's short-term and long-term money. There's like your day-to-day budgeting side, but then there's also what do you have for your future? Like what retirement money do you have available to you and what's happening in that part of your life? And again, we tend to not, money is a very difficult conversation. It is something that's, very uncomfortable to talk about a lot of times. So, and it is one of the number one causes of divorce. And whether that's due to financial coercion or control issues, financial abuse, it's just having different money language. I mean, different money. We talked a little bit about, people who are spenders versus savers, or they operate.
I'm a spender. I'm a recovering spender because I'm trying. I'm trying hard. This podcast is teaching me all the things I should be doing. So I'm a recovering spender.
Right. Well, and it's hard. I mean, these are just realities. And there's people who save up a lot of money to do like a big project, and then they're okay spending that money. There's some people, like I tend to, once I hit a number in my bank account, I never want to go below that number. So like I operate from this space where even though I saved for something, like maybe it's a really amazing vacation or a house project, suddenly I'm like, the numbers go down because I'm spending the money I planned to spend, but I have a lot of angst around that. And so it's, there's just different types. And when you're partnered with someone, which is, when typically when you're in a marriage, you do financially, partner up with each other. That's hard to reconcile some of those, differences. And so once you're faced with a divorce and you now have to kind of, now fall back on what it is that you do and how you operate, it's important to sort of be cognizant of those things as you're going through that transition.
Yeah, this is really fascinating. And honestly, Heather, I could have you on every single episode talking about a different aspect of relationships and finance. But today, I want us to focus really on recovering financially after divorce. So, we've gone through the whole throes of divorce. Anyone that's been through it, like you and I have, it's incredibly stressful and upsetting and all of the things. But I want our listeners to come away from this episode with some hope and some structure on how they can rebuild your lives, because, you can rebuild your life. You and I are both testament to that. And so let's talk about one really important aspect of rebuilding financially after divorce, which is credit. So Heather, talk to me a little bit about the benefits of having credit in your own name and the necessity of having credit in your own name, frankly, and how do you even go about building up credit if it's something you've never really had before?
Yeah, it is one of the most surprising things is when people realize they don't have credit. And even though they've been running around with credit cards and been able to spend a lot of money per month, if the credit isn't in, if you're not the primary account holder, you're not getting the benefit in your name, your individual name, to have credit. So to build credit and a history of credit. And it's very important. In our world, you and I had spoken previously about you moving to America and not having any credit. And my family did the same. They moved to Australia and they had no credit in Australia. So trying to build that from scratch is it takes a lot of time. So the number one thing I tell people to do is go run your credit report right away. And, and it can also bring up a lot of other things. Like we have found accounts that my clients didn't even know existed that their spouses had taken out in their names. That's not good news. But, or we found that they have no credit. And if you're faced with a situation where either maybe you're going to want to keep the house and you have the assets to do it, but you don't have the credit to do it, then you're never going to be able to get a mortgage into your name. Even if you could afford it, the mortgage lender is going to look at you and be like, oh, you don't have any credit history. Like we have nothing to rely upon. So, or if you need to replace a car or go out and rent your own apartment or your own, house, that's been one of the biggest things is when people want to move out, you then have to get a cosigner. And, and typically, you're at an age where family members don't really want to do that for you anymore. And you don't want to continue to rely on your ex-spouse for that. So go check your credit. Everyone, no matter where you're at in any stage in life, you should be doing this regularly anyway. And there's a lot of free credit bureaus out there. You can check your credit monthly at a different bureau and it's always, free. So most of us have had our identity stolen. Sign up for the LifeLock or the things that are sent to you to help you, manage your credit that way as well.
Do you know what I was really surprised at, Heather? Sorry to interrupt, but so as you mentioned, and I've discussed on our previous episode, I had no credit history when I moved here, obviously, because I'd never lived in the States before. And it's taken me a long time to even get to the point where I'm accepted for a store card, for example, or a $500 limit credit card. In fact, I think it was $300 limit to start with, and it's been bumped up to $500 because I'm such a great bet now to give a credit card to. But what I was really surprised is I'd been on my husband's American Express card, for example, for several years as, a secondary card holder. And that appears to have had no impact at all on developing a credit history for myself. So, why is that?
Because they're the guarantor of the card. So if you go rogue on that card, he's still the stopgap to actually be the one to pay the card balance. Okay. So it's not, the buck isn't going to stop with you. It's going to stop with him. And so the creditors give the benefit of that to the payor at the end of the day.
Okay, well, thank
So,
you for clearing that up because I was always really surprised to find that I had no credit history. I'm like, well, hang on a second. I'm on an Amex account that's very well managed, but it obviously didn't matter. But okay, so we know that we have to build a credit report, credit ratings for ourselves in our own names. So how do we go about like getting credit? For example, a credit card.
so you can go to, I mean, really anywhere. You can start with your bank, and
Mm-hmm.
your bank is typically can be a good place to start because they know you have money in your account. So you can prepay for some credit. Like you can say, okay, I'm going to deposit $500 on a card and then spend it down and then refill it versus
Okay.
being, that's sort of the inverse of how a credit card typically would work, right? You pay in arrears rather
Yes.
than in advance.
Yeah, that
But
almost sounds like a debit card to me, but you can do that then. You can prepay on a
you
credit
can
card.
prepay on a credit card, and
Ah,
just in case you just can't get a credit card at all. I mean, it's more
okay.
ideal if you get issued some level, to your point, of like $500 a month for credit. And then use it. You have to use it. You've got to every month, like your credit utilization score, which is the percentage. Like if you have a $500 limit, put it up to 450 every month and pay the 450 off. Like don't go over your credit limit because that's also looks bad. But it's the utilization percentage matters. The fact that you are using it matters. Frequency. And so anything that you can do on that front, just every month to do it is great.
So
Putting
could it
things,
be like, for example, Heather, could it be, you have like one payment of, say your limit's 500. My credit card limit happens to be that right now too. So for example, would it be better for me to pay, one thing worth $450 a month, or is it better to, maybe use it 10 times, but for smaller amounts? Like, what do they prefer?
either one is actually fine. They
Okay.
look at the statement balance for the percentage of utilization of your credit.
Hmm.
So that's where they'll look. And you can get like an app like Credit Karma or something like that you can monitor your credit score. So like my husband and I have a little game we play of whose score is higher. So, it's like teamwork. So we look and I was like, okay, wait, now how do I get my credit up? So I was looking at some of the gamesmanship of this recently, and you want to pay, not at the deadline. You want to pay about a week in advance of when the payment is due, because that's when
Oh,
these things are also reported to credit bureaus. So I noticed that when I started paying things in advance, because I'm at the very top of the credit score, so I'm eking out little points here and there. You can pay, like a week in advance, so you're not going right up to that deadline of when the payment is due. That looks favorable. Keeping cards open, closing accounts actually hits your credit negatively. And
really?
it's a little bit like counterintuitive because I'm like I ran my credit score recently, and I don't know, like I'm a little bit of a sucker if I'm going in and they're like, oh, if you open a credit card today, you're going to save $200 at Ulta or Sephora or whatever when I'm shopping with my girls. So I end up like, okay, fine, I'll get the credit card, and but I won't ever use it again. But you need to leave those accounts open if you can, because if you close them, that reduces your credit that's available to you in your universe.
Oh, okay. So that's interesting. So I was very recently in Victoria's Secret and they, went through the usual spiel of, oh, you can save this today if you open a card. And before I've just said, there's no point. I've got no credit
Yeah.
history. But the other week I was like, okay, maybe just check if I'm eligible. Anyway, I got approved, which was like another huge step in my new financial journey. And so now I have this Victoria's Secret store card, which I have no intention of running up. But so, okay, so with that then, is it still important that I spend on it regularly, or can I mean, is it the same concept that applies to a store card that it would to a credit card?
If it's a store card, I tend to not say that you need to spend on it. But what I'm learning with a lot of store cards right now, like I think my Ulta one, for example, I don't know that my Victoria's Secret one, I've got them all. It's an actual MasterCard also. And they do have some promo events that are like, hey, use this card at other places and you'll get points for, maybe it's your Victoria's Secret point account or whatever. But it's, you want to be using a certain percentage of your credit. Like I have so much credit available to me that I'm not going to use more than like 3% of my credit, at any given time, or 5, because I don't have the cash flow to pay my credit available. So I've tipped the scales on credit available versus what my cash flow needs are.
Your credit score goals, you are, Heather. That's where I want to be.
It's good because I have that flexibility. Credit cards are such a scary dance. I mean, you really need to, like my husband, for a long time, if he uses his credit card, he just goes in and immediately transfers the amount that he just charged from his bank.
Oh, wow.
And I'm kind of like, well, and with interest rates being low in our bank account, I'm like, okay, that's fine. But, you don't need to be paying it off real time. But that's when I think he had some credit issues in his past. So that's just his behavior pattern, right? So, and he always just wants to look at his bank account and know that that's how much cash he has. So you need to manage how you look at your cash flow, because you don't want to get ahead of how much cash you have available and then be carrying a balance. And by any means these days, especially because I can't believe the interest rates on credit cards.
I know, they're absolutely crazy. Okay, so that's credit cards, and that's kind of, building our credit score. Just before we move on, is there anything else that we can do to improve our credit score, or, in my case, actually create one from scratch?
Yes, there are. So things like car loans. So even if you're in a relationship, like make sure that your name is on the car loan, or your name is on the mortgage, or your name is on, maybe you're doing a home equity line of credit, or you're going to take out a personal loan in order to do debt consolidation, whatever. Like it's really important to have things out there and that will definitely help you build credit, particularly, vehicle loans, mortgages, anything like that are good. That's kind of good debt.
Okay. So interestingly, Lisa, who was a guest on our podcast, quite a few episodes back now, but she was talking about good debt versus bad debt. And that's something I've just learned. So good debt, for example, you mean things like a mortgage, or it could be a student loan, something that's either building equity or building your future, basically, versus bad debt, which I guess credit cards potentially could be that, couldn't they?
Yes. If you're carrying balances on credit cards, that would usually be considered bad debt.
Okay.
And really if you go look, like I was so shocked by this. I got a notice on, I think it was like my Nordstrom credit card. Mm-hmm. And they were like, here's your new interest rates for 2025. And it was 31%.
Oh my God.
And I was like, excuse me? Like,
wow, that's insane.
I don't ever carry a balance on it, but I'm like, that is absolutely insane. I mean, if you were going to be carrying a balance on that credit card, I mean, you're paying 31% of your purchase. I mean, that's like bad money. You have to think about how much you're spending to acquire whatever it is you're spending, plus the interest on your credit card debt.
Okay, so just off the back of that, before we move on, is there like how much, for example, if we were looking at a card with crazy high interest rates, should we rule that out? I mean, should that be a deciding factor on whether we even accept that particular credit?
So, this Nordstrom example sort of blew me away, because part of what happens when you have higher credit score, you tend to get discount interest rates on things like credit cards, right? So this one was obviously out of the ordinary. It's very hard to find a credit card right now below like 17%. Mm-hmm. One of the things that I'll tell you, if you are in credit card debt, you can call the card holders and negotiate a payment plan. And they can, sometimes what they'll do is they'll freeze your credit card at that point, and they're just like, great, you're going to pay this down at 10% instead of 17 or 25 or whatever. So I always encourage my clients to call, or they'll say, okay, you can pay off that balance at this much, but if you charge on your credit card again, it's going to be at the normal rate. The thing to be careful about at that is then whatever payments you apply typically will be applied to the lower rate rather than the higher rate balances. And so you need to look at that dance because they want to obviously continue to charge you the higher percentage rate. But most credit card companies will negotiate with you. So that's important. The other thing to look at is a lot of credit cards offer these, 6-month, low APR balance transfers. Mm-hmm. So same thing though, if you're going to balance transfer to that card, be careful about what you're still charging on that card because again, they'll pay off the low percentage and not the higher percentage. So just look at those nuances when you're looking at credit card offers.
Okay, all right. Well, thank you for that. And it's interesting that you said basically speak to your card issuer. So don't be scared. I guess the message here is don't be scared to contact them. So if you feel like you're getting into a bit of a mess, you can call them, and it sounds like they're pretty open to negotiating with you and setting something up that suits both parties.
They will do that, as well as the other topic I'll bring up is medical debt. So
that's a big one. Yes.
I had a pretty significant medical debt in my early 20s. And I called the hospital and the doctors groups. And I'm like, look, I'm a student. I got emergency surgery uninsured. My intention is I really want to pay this off. I feel terrible about this. What do I do? And they actually put me in touch with some grant programs. They put me into some matching payment programs, and then they gave me credits as I was paying things down. They would pay down, I'd pay $200 one month, and then they would give me a credit of $400. So they doubled my payment credit. So there are a lot of places that you can get some extra help. And exactly to your point, don't be afraid to call the credit card companies. I mean, they're making loads of money off of our interest right now in our country.
Yes.
I mean, we're at the largest credit card debt in U.S. history right now. So they are working with consumers.
Okay. And maybe we can, we can mention some of these resources in our show notes as well. So our listeners have somewhere to go and check this out. So, well, thank you for discussing credit cards. What about our future? What about saving? What about retirement accounts? Retirement in particular, when you go through a divorce, I don't know, I wasn't thinking about retirement when I was going through my divorce. I was thinking about how do I, right here and now, what does my financial future look like? So, post-divorce, let's talk about that because I know that in my situation, for example, my current husband, touch wood, nothing's going to happen with our marriage, but, he has, very healthy retirement account, and I don't. I'm starting from scratch. So tell me about that. Why is it so important to be aware of your retirement savings?
It's very important to be, and whether you're in a happy marriage or a unhappy, it's really important to understand the trajectory of where are you at, and in the divorce world, unfortunately, a lot of my clients are empty nesters. So it's people who are in their mid to late 50s, and they were planning their retirement on being together, but suddenly now they're going to split their retirement because. For the most part, if the retirement, this is not going to be for your particular case, but for the most part, you would end up splitting the retirement accounts.
Okay.
And therefore you have some, but you have half of what you had before. And you have to imagine that, when you go into retirement, you still have to support your household and your general lifestyle and things like that. So, and just the honest truth of when you are the financial outspouse, I had this with my ex-husband because I stayed home for about 6 years before we got divorced. And so I had to go rebuild my income. And while he's still working, he's still putting retirement away and I'm down here. So while I have what we had when we split up, and I put a little bit more into my retirement, he's been able to continue to put a lot into retirement as having a more traditional job. So it is very important to make sure that you do take that as one of your assets. A lot of people are like, oh, I don't need the retirement dollars. I want the house instead. And I'm like, no, we're not trading. They're not equally taxed. They're not equal cash access. They have a different purpose in your financial portfolio. So it is important to really be considering, what retirement assets you have available when you are going through a divorce. And then to figure out how you're going to shore those up for yourself going into the future. So I work with a lot of financial planners with my clients. We collaborate a lot so that the question always comes up like, am I going to be financially okay and after my divorce? And the long-term planning is definitely a key part of it besides the day-to-day cash flow in the short term.
So I'm going to ask you a question, which is more for me than anything, because I'm still quite a newbie here in the States. But can you describe and explain the different types of retirement accounts? I mean, I hear 401k, I hear IRA. Tell our listeners a little bit about the differences.
So like a 401k is usually an employer-sponsored plan. So that's, you work for a company and they're willing to match and do things, to help you build your retirement. Typically with an IRA or an IRA or there's either a Roth or a SEP or a self-employment plan. Those are ones that are done just for you donating on an annual basis. Or you've left a company and you roll over the 401k because you're no longer in that company's plan into an IRA. And then you can manage it, on your own or with the partnership of your financial planner. So there's lots of different, and then, there's pensions, there's defined benefit pension plans. Those are, less and less frequent. But they definitely come up with teachers, firefighters, police officers, general people who are in unions, still have some level of pension plans usually. And that means that you have a set based on typically a level of tenure that you've been with your job. 20 years, you get a certain pension, kind of guaranteed payment amount. A lot of military pension people. So those are just a couple of different. And you want to understand how all of those work and what the tax effect is, because they are affected differently in the tax world.
I feel like we need a whole episode on this actually, because this is really quite a complex topic and one that is extremely important. And you've just kind of given us a bit of an oversight on how important it is. One thing I did want to mention, why should we make regular contributions to our retirement account? Why is that so important?
Oh gosh, we've talked about how we have teenagers and I have young stepsons in their 20s, and the more honestly that you can put away and do in your younger years, the better return you're going to have over the long haul. If you start retirement savings in your 40s and 50s, you just don't have the runway to get that return. And, that iterative return, it's like that cumulative part of things. So, the earlier that you can start putting away for your retirement is, the better. But it's hard in our younger years. Let's be honest. We're like trying. So I was making some different choices between, I'm like, well, I bought a house and now I was living with someone I'm not. I can't pay my mortgage with also doing my 401k. So I stopped my 401k for a period. And, thankfully my house value went up, but you definitely want to try to keep putting money away that is going to grow, tax deferred or tax free, depending on what vehicle you're using, for those later years in life when you don't have the, capability or capacity to be, continuing to generate cash flow. You need those assets to be, available for you to live on.
Well, as I said a few minutes ago, I think we need an episode solely about this, because this is just a fascinating subject and it's one that I feel we need to dedicate a bit more time to. But just finally, Heather, what about our long-term rather financial goals and planning? How can we, go about, setting and kind of, really understanding what our financial goals should be moving forward?
This is something that where I end up partnering with my clients and certified financial planners in my community, because they're the experts. I bring to the table like what is their budget? Like, do they even understand what you're spending? Do you get what your lifestyle, requires, or what you would like your lifestyle to be supported by, right? And those are all key inputs into then having those longer term conversations that are like, okay, are you anticipating staying in your house? Are you anticipating wanting to leave a legacy for your kids? Are you anticipating having big college expenses? Like, they look in those out years, and then they've got this whole analysis software that helps you understand, can you meet those goals? Or how much money do you also need to have in your savings? Like, in my clients' budgets, there's always a savings and investment section. And they're like, but that's not really like spending. And I'm like, well, it is, because you're receiving, let's pretend you get $5,000 a month and you want to put away, $500 a month in savings. That's an expense line item in that $500 or the $5,000 of cash flow. And they're like, oh, okay. So I'm like, so savings is really in quote unquote expense. It's a part of what, where you're compartmentalizing the cash you have. So it's really important. I think really, if you can get yourself with a certified financial planner for that long-term piece, and then someone who's helping you with the day-to-day budgeting piece, that is the foundation for meeting those long-term goals. Because if you're way off here, then you're not able to save for those future goals, is important. So I like using those resources for people for the longer-term planning part.
Well, Heather, I could talk to you for hours, so I'm definitely going to have to get you back on the show and we'll speak some more. But in the meantime, how can women get a hold of you?
Yes, absolutely. You can check out both my websites, divorcetransitionmentors.com or splitfyi.com for my community support resources. And we'd love to see anyone join. We have people from around the country and the UK and Canada that join us on that. So just if you need some camaraderie going through divorce, and then I do a weekly coaching hours, it's a fantastic resource.
I love that. And yeah, for our listeners, Heather's fantastic. So I would highly recommend that you check her out. But thank you, Heather. I can't wait to have you back on the show. So with that brings us to the end of today's episode of Fearless Money Management. Please don't forget to subscribe, like, and leave a review. Your support helps us to reach even more amazing women on their journey to financial freedom. Bye for now.